Welcome to this walkthrough of the revised and updated Solar Park Financial Model template from efinancialmodels.com. Before we start, don't forget to hit the subscribe button to become notified whenever we release a new video. What I'm presenting here is an Excel spreadsheet template, and I'm including the link to the template in the description to this video below. The purpose of this template is to model the financial prospects of a solar park project and a utility scale solar park. We want to understand if it's a good idea to build this park by analyzing its financial feasibility. This model assumes that the produced electricity is either sold via a PPA, a power purchase agreement, which is basically an offtake agreement during a specified period of years, for instance 20 years at a specified price, or also as a certificate which is priced as a markup to the normal market price. Whoever purchased the certificate will pay a premium also during a specified period of time. In addition, we want also to include the option to analyze what happens if you could claim carbon credits for this type of project and how would this impact the financial feasibility. The analysis is done in a way that we calculate that we build a financial forecast on a monthly basis during a period of up to 40 years. And then we build all the forecasted financial statements, such as the income statement, balance sheet, cash flow statement. We calculate all the financial ratios. We look at the free cash flows and we look at the resulting IRRs and all the other profitability and investment metrics in order to figure out if that's a good idea to go ahead with this project or not. And lastly, we also want to have the ability to run quick scenarios to see what happens if some of the key assumptions change and how would this affect the feasibility of this solar park project. The model foresees the park can be built either in 1 or up to 3 phases, and we also want to understand what happens if you only build 1 phase or if you also include phase 2 and 3, if that's applicable to the project. And lastly, we also want to understand how this looks from a capital provider point of view, in specific banks or investors. So we want to look how the debt schedule will look like from a bank's point of view, and if that is something which can get them excited to invest into that project. What are the risks, what are the returns, how are the financial ratios, are they in line in what they normally need? And we basically want to prepare for this discussion. And the same thing also for investors, for capital providers. And here to be aware of is that we are taking the view of a developer. So we're at the launch stage, but sometimes the park, even before it gets constructed, the project is flipped to another developer. So it's one scenario we also might want to study. And then lastly, once the park is built and all the risk is out, the park might be sold to another investor who will basically hold the park and just produce electricity until end of life of this park. And therefore, we want also to study how this looks from an investor point of view. And especially as a developer, we also want to figure out, is it a better idea to actually flip the park or just to keep holding on until forever? So that we know how all these scenarios will look like. And what we do then is we have different types of investors we could think of. We can take into account, and we want to basically also figure out what will be the profitability or the return at the investor level, taking into account how much equity stake they receive, how much they have to invest, how much they have to finance, so that we also understand how this will look from an investor point of view. So let's have a look how to work with this template. For this, we basically have to work through the assumption sheet. There are a variety of assumptions regarding to the timeline, the generation of electricity, pricing, taxes, the investment, the financing of the investment, then also the operating costs while the park is in operation, and then also we need to have a look at the required funding, if we are going to fund everything at the beginning or if we split this in different funding rounds. Let's dive right into it. So the first thing you have to do is to basically enter the date of when the forecast starts. For instance, you can set the date right away, or you can set a convenient date whenever the forecast starts. And then we start to project on a month-per-month basis for up to 40 years what's going to happen with our solar park. Then what we need to define is the timing of the different phases. This park has 3 phases, or we can use all of them, or we can only use phase 1. It's really up to you. And what we need to define is how long the construction period will take. Here is always the duration. So let's say this takes 9 or 8 months. We start in year 1 in January. This actually would make more sense if I change the starting date of the forecast to January. So this is then basically in the first months that the construction starts, and means we finish construction by September. And this is for phase 1. For phase 2 and 4, here you can see it's a bit delayed. We have here a gap of 2 years, and what's going to happen is in phase 1, in this case, example, we're building a 8 megawatt peak, and then phase 2 and phase 3, we're just adding 1 megawatt peak to expand the capacity slightly. Back to constructions, so we define duration, start date, and the end date will then be calculated. Then we have to estimate how long will the park be in operation. This can, for instance, be something between 30 or 35 years. Keep in mind the model goes 40 years out. So we choose something in here. That's a typical lifespan of such a park. And this means once construction is ended, next month basically the project starts, and then it will go on for 35 years. And this also means the phase 1 starts then at the same time. Phase 2 and 3 depend on when the construction finishes here, then we start operations. When the construction is done at the very beginning, the park is built, but it's not being commissioned yet. There is a commissioning period where all the specs will be checked and make sure that the park runs as expected. So there's a period of a couple of months, and this comes before a power purchase agreement is put into place. And this also means that during that time, the produced electricity is not yet subject to the terms or the price of a PPA. It can be sold at whatever rate can be negotiated. Once this commission period is over, you see this starts right away, 6 months, and takes us to March. And then once this is accepted, then we start in basically next month, we start with the PPA. In this case, 25 years, or some PPAs, they are taking less, so we can adjust the forecast period as needed. Another option is that instead of a fixed price PPA, that we could certify that this electricity is produced from a solar park. And then what we do is we sell to the market, and in addition we sell a certificate. This is a bit more riskier because the market prices can go up and down, and only the premium, which is not the same amount as the fixed price as the total value of the electricity sold, is only a certificate, the price premium. This model allows you to do both, and here there are switches. You can basically say which under which regime you're going to sell. Here I'm turning the the certificate, disabling this, and I'm focusing on the PPA. Another option is that we have a case that if we are replacing electricity generated from a lot of fossil fuel sources now by electricity produced from clean sources, that we can claim and certify our produced electricity to qualify for carbon credits. And then here the question is, when does this start? Keep in mind there's a different process. This needs first to be certified and accepted, and then there is also an agreement in place for how many years these carbon credits are being paid. That could be another way to monetize. And here you can either include or you can exclude carbon credits as you like and as it may be conservative. So the timeline is set with this. As we already touched on this, electricity generation, we need to basically define which phase brings which capacity online, and the timing then helps us to plot this on the timeline. Then each of these phases, if the location of phase 1 and 3 are different, this might also lead to that actually the solar year could be different. Sometimes this not only depends on location, but also how the quality of the panels or how the panels are managed, if they are fixed or they are basically tracking the sunlight. So this could also all have different effects. So here we have foreseen that there might be different solar yields. And then on average, we get an average yield produced by the park. If you want to analyze this further, we then also need to say this is the annual yield. So how does this yield, is this yield being produced on a monthly basis? For some geographic location, there is a peak in summer and maybe less electricity produced in winter. So here we have percentages you can adjust so that you get a pattern here. And if you want to zoom in here, we can also just look at phase 1, how this basically looks like, and then also include what happens if we include phase 2 and phase 3. And so we can get this monthly distribution pattern, and this pattern is then also reflected in our financial projections. In the month of January, we're receiving less electricity produced than if we are in one of the summer months. And this helps us better to understand the timing of the cash flows and to basically further fine-tune and understand the forecast. And now, knowing this, we can estimate the total electricity production for this park, and we can go again to include all the phases. And you can see that in this case, phase 1, the 8 megawatt we installed, that's of course the biggest contributor of the produced electricity. And then we have some additional capacity added by phase 2 and phase 3. And then we bring this up to total 15 megawatt hours per year. For solar, the one effect we have to take into account is the annual capacity decline. So these solar parks, they're brand new when you put them in place, but due to the weather, the environment, the use, basically we have to expect that the capacity of these panels over time will decline. There are benchmarks in the industry you can use for that, or you have to estimate, but normally these curves, they look like this, so that actually the produced electricity over time will go down, because here we have an old park and here we have a new park. Then, as said, we have worked through all the different sources of revenue, so we have to set the prices for these for the electricity sold under which pricing scheme. The other question is inflation. We have maybe a cost inflation we have to take into account, meaning that our operating costs will go up year by year by a certain percentage to account for inflation. And the question is, what about the prices? Are they also going to be adjusted for inflation or not? And here, every project is different, and it also depends which market you look at. And the option here is to either add inflation or exclude inflation. Then we work through the sources of revenues, and we basically include the revenue source we want to include. The rest we exclude. Here in that case, we exclude carbon credits. I can also include that again. And so we have a quick view of how much revenues we can obtain per year. Here we have a way to estimate the cost of capital, the discount rate. So there are two ways to do it. One is we just estimate and use the discount rate we want to use, or if you want to do it a bit more sophisticated, here would be a KPM, capital asset pricing model you can use to include the mix of equity and debt. We basically estimate the cost of equity by using risk-free rate, the beta, we lever, unlever, we get to the market, we take into account the market premium, multiply by the levered beta, we get to the equity risk premium, maybe there's another risk premium to be added, so we can estimate the cost of equity, and we can estimate the cost of debt. We want to prefer to double check if these calculations correspond what we would estimate the discount rate might be. That's the idea. And then this discount rate can be taken into account for basically just looking at the NPV value when we just project the free cash flows from the park. This should be positive. And B, we can also use this discount rate when we actually forecast a future valuation of this park. And in that case, what we do is we always discount the remaining free cash flows of the park at a 10% discount rate, and this way we can get a DCF value of or DCF valuation of this park. The next topic we want to work through is the CAPEX topic. So what are the investment costs of the park? If we are going to build this in one phase or multiple phases, we can split up the costs, and we also want to know what's basically the cost per megawatt of installed capacity, so we can compare, are we in line with the other phase. In this case, you see these are just example numbers, is a bit low, but you get the idea. We just want to know what's the relative cost, and then this number tells us the total CAPEX budget we're going to put in place. As you can see, phase 1, 8 megawatt in year 1, phase 2, 1 additional megawatt added in year 2, and phase 3, 1 additional megawatt added in year 3. The next assumption is financing. So we know now the total investment costs. How much of these investment costs are going to be financed by banks? And either we can enter here the loan to value ratio. How much of this amount is going to be financed by debt? What's the interest rate? Do we accrue the interest during construction? That's most likely a yes. And then we can also enter here the grace period and then also the repayment terms, and then this will lead to a debt schedule so that we can understand what's the foreseeable debt balance is going to look like, how much debt is drawn down, how much interest is being accrued, and then when will the repayment start, so we can take this into account when we build our free cash flow forecast. Once more, you can see the debt schedule here below, just summarized on an annual basis, and we also can see the resulting bank financial ratios. Then in terms of the revenues, we said that one option is also to get our park certified for carbon credits. Here there is a simple model added, and basically the question is, if we would have to produce the electricity not via solar but with the standard way of producing electricity, how much fossil fuels are used in the current electricity mix? How much carbon emission does that generate? And if you replace the generation of electricity the traditional way, how much CO2 emission could we save? And these CO2 emissions, these are now subject to certification. How much of those can be certified? What's then also the carbon credit per ton we can obtain from that. Next set of assumptions we need to work through are operation and maintenance costs. These are the recurring assumptions while you are operating the park. And we basically need to figure out what will be the cost budget for operating this park. So we have some costs, they might be related to revenues, or they might be related to the amount of megawatt hours we produce or the amount of megawatt peaks we have installed. And you can basically then go through and add all your line items, what costs you expect, and we enter these on a yearly basis. And basically then the question is, when you also add phase 2 and phase 3, how much of additional costs will be added by these phases? So at the end of the day, we look at the cumulative costs, and we want to basically see what is the total costs, including phase 3. Once all the phases are built, what will be the annual costs for this park? If you look at it on a monthly basis, we translate it and work out what are the corresponding monthly costs for these line items. And then we have pretty much already built the profitability projections of our solar park. Here's a summary, and the detailed calculation you will find all on the monthly and then the yearly sheet, and you can basically go through and revise and check if these assumptions make sense. They are basically presented topic by topic, started by electricity production, the electricity sales, carbon credits, the pricing, the revenues, operation and maintenance. Just make sure you're comfortable with all this, or go back and revise the assumptions as needed. Then we also look at what now the model tells us based on the forecast. We now aggregate the forecast into a yearly figure, and you can see already the financial projections are already calculated. So we have here the projected income statement, balance sheet, cash flow, and all the financial ratios, and a bit further down with free cash flow forecast. Now what the model will do, the model will calculate the required funding. This is based on the free cash flow forecast. And then we need to look at the uses and source of funds, and now you can see there is the debt financing. This is 80% of the CAPEX, and all the rest, there's also some net working capital to be financed, and that means all the rest will have to be financed through equity. Now here I like rounded numbers, so what I'm going to do, I'm going to round it up. I'm also adding some more cash reserves, and so I'm doing a goal seek to figure out what the cash reserve needs to be in order to get to a rounded equity number. And this equity will have to be injected into the company, and here you can see we have here 3 steps how to do that. We first need to focus on the first step and when to inject the equity, and we can do that in month 0. And we say 100% of the equity has to be injected upfront to cover all the expenses which are not paid by debt. Alternatively, you could also inject some of the equity later, and then maybe also combine this with a change in shareholders. We just get to that. In terms of the shareholders, we have here the list of shareholders. At the beginning we assume that the company is owned 100% by developers, and then what's happening is, in order to raise funding, some of the shares are traded, they're going to investors, so the investor gets 80% in this case, the developer remains with 20%. And then here we keep track of who is selling to whom how much of the equity. So this always has plus minus, need to result in a 0% change. And then you can see that here now the ownership changes. And the idea is, doing it this way, is the project is fully financed, all the equity is in there, but we can then actually start to flip the project. That means the investors, you see here, the developer, he can slowly start to get out and sell some of his equity, and then new investors come in and they will be the new owners of the company. So here at launch, a lot of risks. Once the project is planned, permits are in place, the PPA is in place, project has less risks, then it's a time to bring in new investors. The developer might partially take some cash out, and then park gets built, and then here might be another step needed where basically new investors come in, and basically the previous investors will partly exit, and then the new investors will buy and hold forever. And what we can do here is this is a question about valuation, and what we can see here is that at launch, a lot of risk, so whoever participates at the beginning needs to be compensated high, so we need at least 20-30% IRR, and this then allows us to put forward a possible valuation. And if we want to exit in a flip scenario, the question is at what IRR new investors will come in, and using that IRR to discount the value, then the valuation goes up. And if we then, at the end, once the park is constructed, we basically say now we only need a 12% return, and then basically the project can get valued at a 12% discount rate. So this is basically how we can figure out what is the equity value, which is the basis for buying and selling these equity stakes. And all we do basically here is to change the discount rate. At the beginning it's riskier, then it's less riskier, and at the end it's even less riskier. And lower discount rate means higher equity valuation. We have here other assumptions in terms of the cash reserve, when to inject. These are more details. Dividends, assuming once the project is stable, can service its debt, we can say when to start to pay dividends. And then pretty much we are through with setting or parameterizing our model, and then what we all have to do is to review the forecast, if that makes sense. And for this we can go to the detailed summary sheet, and where you basically can see a summary of the projected income. So you can see where do we get the money from which source of sales. And you can see in this chart, revenues initially go up because what's happening here is we bring new capacity online. Then the capacity degression takes place, so the produced volumes of electricity goes down, and this is still sold under a fixed price PPA. And then you see here the PPA expires, and suddenly we cannot sell at the PPA prices anymore. If you go here, you see the PPA price is $65 per megawatt, and then suddenly we have to sell at the market price. The market price can be different or could be the same depending on your case, but normally we'll then see a change in revenues after the PPA expires. And then here the park just sells electricity at market price, and then here end of life is reached. That's a typical pattern. If you look at the free cash flow forecast, you can see clearly this project is producing cash, so that's great. If you look at the debt schedule, what we want to see is how much debt we have to take on to finance the park, and you can see we draw down the debt here to finance the CAPEX, and then slowly the debt is being repaid. And if we remember, the repayment period of the debt is, where we have it, we are looking at this facility, and here we have it. It's basically over 20 years the debt is being repaid. So you could also assume what would happen if we would repay the debt faster, 15 years. You can go back and then you basically see the new debt schedule, and you might want to look also at the ratios. And now you see some of these ratios, they turn red, and especially when I look out for the debt service coverage ratio. Debt service coverage ratio basically is, tells you have debt to service consisting of interest and principal repayments, and basically what we calculate here is the free cash flow of the project, which is this line item here. How many times does it cover the debt service? And you can see here it's getting, here is 1 year where it gets very tight. So if you have this scenario, what you can do is you can go back and see if this gets better if you extend the repayment. And you can see if you extend the repayment period, means less principal repayment has been done earlier on, and so debt service coverage ratio increases, and it looks more attractive from a bank's point of view. By the way, you can define what likely covenants or covenant ratios are being used by the banks, and if those are exceeded, then it will show red here. So you can play around and see how this looks like. Balance sheet we have a look at. So here you can see we generate quite some cash, and you see at the beginning we have cash, and then it's all being used to produce, basically to invest in the park. Then here we start to service the debt, we have some excess cash, we build up a cash reserve, and then here you can see it's always stable, because as of year 6, what's happening is we're starting to pay out dividends. Let's have a look at the cash flow statement, and this is what's happening. So this means the cash here goes up, and then here it stays the same, because everything above this threshold we are distributing as dividends as per our dividend assumptions here. That's a cash sweep assumption starting as of year 5. We have a look at the cash flow statements. We can see how much dividends we pay, what's the remaining cash balance. Revenue breakdown, we can see here once more where do the revenues come from, and in this case you might remember we have here revenues from electricity sale via PPA at the beginning, then later it will be market sales and carbon credits. We assume here some income from carbon credits, and then this is reflected here in the chart. And if you want to play this very safe, let's say we want to calculate this more conservative, so no income from carbon credit, we just go here to the summary sheet, quick scenario, we disable that. So assumption sheet, you see that carbon credits now are excluded, and now it basically will look like, and it will not include the revenues from carbon credits. So we can see how would that scenario look like. We also need to look at taxes, and basically what you can see here, there are no tax credits assumed. Actually, such projects often they get tax credits. So what type of credits normally are offered? Either tax loss carry forwards, investment tax credits, or production tax credits. In this case, we might want to, most likely we can expect some investment tax credits. We go back, and then you can see here there are losses produced initially, there are tax credits built up, and then the tax credits being used, and then only from year 10 we start to pay taxes. And there is a whole tax model included, and which basically does all the calculations for you and keeps track of how many tax credits are built up, are being used, by when, what's the balance, and when you will start paying taxes. And this is all driven by the assumptions of the tax assumptions here. As we mentioned, this project consists of 3 phases. We can see here the contribution of each phase, how the different yields compare. What we have here is also a summary of the levelized cost of energy. And if you are interested in details how this is calculated, this is a section here on the yearly sheet. This link takes you there, and you can see how this is calculated. And basically this allows you to compare how expensive it is, the cost of electricity produced by this park compared to another solar park project. Every project has a bit of different levelized cost of electricity, and so this calculation allows us to compare project by project, which one is more expensive, which one is cheaper. In terms of carbon credits, I've now excluded carbon credits, but let me just add it back. If I add back the carbon credits, so you can see how many CO2 emissions are saved over the lifetime. And if we get these savings in CO2 certified, we can sell this on the market for carbon credits, and then we can get another income stream. And then we can see how much this adds up to over the project's lifetime. Then overall, we will look at the project from a financial feasibility point of view. We already checked that the project comes up with a reasonable proposition from a bank's point of view. This means the banks, they want to see that all these ratios, they are in place. They also want to see especially the LTV ratio, that this is covered by the value of the park and its remaining value. And now the feasibility, we also need to look at it more from an investor point of view. So we want to see if we just look at the park itself before taking account how exactly we are financing with debt equity. Does this is attractive? Does it exceed its cost of capital? If in order to, we say the cost of capital is about, the weighted average cost of capital is about 10%, and now we are higher, so this would mean this is a good idea to proceed this project because we are creating economic value. If we look it after receiving debt financing, meaning we only have to put in this case, 20% of the required amount of financing amount down as equity, then we actually can even get a higher return, and this looks pretty attractive. Then we also have the short summary of the project, the timeline, and also here the revenue and EBITDA per megawatt installed capacity or per megawatt hour produced, and basically all the KPIs once more summarized in these charts. If we look at the expected valuation of the project, this is an interesting chart. So what we're doing here is we look at the case. We want to figure out, at the moment, we're building this project and we're going to spend X amount of dollars to basically build it, and then what's the value of this park, and we use DCF valuation to determine the value. And you can see once this is built, if we take into account all the future free cash flows of the project lifetime remaining and we discount them at 10%, what will be the enterprise value of the park? And now the interesting thing is that you can see that this enterprise value will go down. Why it's going down? Because we're including less and less years of your mining cash flows. So at the end of the lifetime, there are only a few years left of free cash flow generated, and we discount them, then the value will go down over time. And this is basically what the chart here is telling you, so that over the lifetime, as the park gets older and less lifetime is remaining, it will decrease in value. And we do this here for enterprise value and equity value, which is basically deduct the financial debt and we add the cash on the balance sheet, and in this case it follows the same pattern. And now we look at the project from investor point of view. So we know we need to inject in total 1.2 million in equity capital. In this case, we assume this all has to be financed and injected in the project upfront, because at the beginning it's riskier and no bank will finance that, so somebody has to go ahead and put all the equity down. And then the question is if we want to keep on to the project until it's fully built, constructed and put into operation, or if, let's say, during this process we actually might want to flip the park. If we're going to flip the park, we basically have here certain transaction structure in mind. So we start to sell and purchase, and then they will be taken into account to basically figure out who is putting in how much money, who invests how much money, and who takes out how much money. And we then can simulate the investor cash flows, and then we can, during that calculation, we can also figure out what will be the expected IRRs at each investor level. Lastly, let's have another look. So we have here one sheet, which is a general summary sheet, which analyzes the business case. And now what we also want to do is we want to run scenarios. We want to know what happens, let's say, if the PPA price is 10% lower. And now let's see what happens to the IRR. You see the IRR would drop by about 2%. What happens if the market price for electricity drops by 10%? Another drop in IRR. What would happen if we would have our PPA prices adjusted for inflation? The inflation assumption was 2%, so let's play that. And you can see then we are back up. If we would manage to add this clause into PPA, it would actually help us to create a great return. Cost inflation, what happens if inflation is higher than anticipated? Let's say it's 1% higher, and you can see it starts to affect the IRR. What happens if the lifetime of the park, let's say it's 5 years less than what we thought? Doesn't really change, because the cash flows they are taken away in this scenario are at the very end, and they don't have that much weight in terms of a present value effect. Another scenario we want to look at is what happens if the solar yield would be higher or lower than anticipated, and you can see this also has quite some impact on the profitability of the project, and this also reflects the importance of choosing a good location. Same also with CAPEX. If CAPEX costs are 10% higher than anticipated, it will directly impact IRR. If they are less, then you can see that's also a way to get a better IRR. We have another sheet in here, that's the sensitivity sheet. This needs to be activated first. So what we do here, there's a switch we have built in that you actually allow sensitivities, and then what we also do is we need to change some of the settings, and actually because this is very calculation intensive, we have to set this to automatic. And now when we, for instance, when we change here the scenario, let's say we have no carbon credits, 12.9. I need to press enter, and then we'll have to wait a bit until this is all calculated. You see now, I can see when this is 12.9, it's all updated. And then the result of that, you see now it's calculating. It goes through data table 2, 3, 4, 5. This normally takes a while because there are a lot of scenarios to run and it's a complex model. Now it's updated. So you just need to have a bit of patience until this is fully calculated. But then what you can see, what the reward is this tornado diagram. And basically what we want to know is which assumptions have the biggest effect on the model. And we do this by basically changing each assumption by a specified range. And then what we want to do is we want to calculate what's the impact, or how will this impact the IRR. So if the IRR is 12.9%, any change you see in price inflation plus minus 2% basically would lead to a lower or higher IRR unlevered in the range of 10.3 to 15.3%. And you see then also that solar yield plays a crucial role, the installed capacity, the price for the PPA, the CAPEX, cost inflation, O&M, market price, and so we can have another view and see, we can have another perspective and basically learn which parameters in this model have the highest impact on the IRR. So let me disable the calculation again so that the model doesn't slow down, and also I switch this setting back. And what we also have here is there are a range of presentation slides prepared, which you could just press print and you could use this for a presentation. We have here the title slide and a time plan. When does the capacity come online? The solar yield, explaining this, explaining the electricity production and revenue breakdown, the CAPEX breakdown, the operation and maintenance budget, the income taxes and credits, tax credits, uses and source of funds. And this goes on a few more slides. Free cash flow forecast, the KPIs, financial feasibility metrics with a debt schedule. This could be presented to a bank. The DCF valuation, the most likely DCF valuation going forward of the project, income statement, balance sheet, cash flow statement, and projected financial ratios. So this model at the end helps you really to understand your solar park project, to look at it from all different kinds of angles, from the developer's point of view, from the next investor's point of view, from the bank's point of view, from a feasibility point of view, from a budget point of view, and get really a comprehensive grasp on the financial implications of performing such a project. So I hope this walkthrough was useful to understand what this template is all about. If you liked this video, please give it a thumbs up, subscribe to our channel, and visit our website efinancialmodels.com. A link to the model template is included in the description below. Thank you for watching.